Hi everyone, this is Paul Cooper with Totes and Notes, and I'm bringing you another note nugget in a minute. And on this episode, we're going to talk about mortgage forbearance and what it means. A forbearance is when your mortgage servicer or lender allows you to temporarily pay your mortgage at a lower payment or pause paying your mortgage. You will eventually have to pay back the reduction or the paused payments, and the most common form is paused payments. So you would negotiate, if you were the borrower, to not pay a certain period of time, maybe it's 3 payments, and those 3 payments would be added on to the end of your loan. This is going to have to be agreed to between the borrower and the lender, and it's pretty flexible. They can agree to a lot of different things. They can agree to just add the payments on to the end. You could agree to not have the interest accrued on it, which is very rare. Usually as a lender, you're going to want that interest. It'd be kind of like deferring your payments if you had anything else, whereas if you had student loans and you needed to defer those payments, you eventually have to pay those payments back, and they're going to accrue interest right now. It's just you're not obligated to pay on them right now. You may have been hearing about this quite a bit in the news. A lot of people have been having forbearance agreements for their mortgages because the economy's been shutting down. One of the downsides is most of the time a forbearance agreement is going to be reported to the credit bureaus, and it will negatively affect your credit. So if you do want to get a forbearance agreement, make sure you read the fine print and make sure to talk to the lender, and if you can, try not to have it reported to the credit bureaus. This can be a pretty good deal for both borrowers and lenders because, especially right now, if a lot of people aren't making payments, then you might want to set something up that way. Everyone knows what's going to be going on into the future, as opposed to just fees and interest piling up and people getting upset because they're not getting paid and people are upset because they can't make payments. But in short, that's what a mortgage forbearance agreement is. It's an agreement between the borrower and the lender to set up some other type of alternative payment schedule during a designated time period. If you have any other questions, don't hesitate to reach out and we'll bring you more videos to you soon.